Imagine this: a country with a centuries-old financial reputation, London's banks, the city, sterling, a symbol of stability. But today, Britain finds itself in what experts call a financial earthquake. Long-term borrowing costs are hitting levels not seen since the late 1990s. The pound is falling within hours, and the government is frantically preparing the November budget, which may determine whether the economy survives. Instead of confidence, there is anxiety. Investors are fleeing British assets, staring at the yield on 30-year government bonds, nearly 6%. For the average person, it's just a number. For London, it's a sentence. Every new loan now costs dramatically more. The pound loses more than 1% in a single day. For one of the world's most traded currencies, that's a blow to confidence comparable to a plane accident. Not yet a catastrophe, but the whole world is watching and realizing something is badly wrong. And here's the key. With debt already exceeding 100% of GDP, Britain is not just a local story. Traders whisper, this is only the first domino. America could be next. In the coming months, Washington must refinance trillions of dollars in debt. If London stumbles, what happens to the United States? Today we'll break it down. Why British gilts turned from a safe haven into a source of panic. How the pound lost investor trust in just 1 year. Why even Trump's minor tariff threats hit London hard. And what awaits the US if the debt spiral accelerates there. This isn't just another financial report. It's a wake-up call for the entire world. The alarm rang on an ordinary weekday. London woke up to find 30-year gilts, bonds once considered the gold standard of stability, suddenly spiking to almost 6%. For a developed economy, this was like a fire alarm. What does it mean in practice? Every new government loan became several times more expensive. If the Treasury once borrowed at 3%, now it was nearly 6%. That's billions in extra costs that don't come from thin air. They drain the budget, erasing schools, hospitals, infrastructure, and social programs. Markets reacted instantly. The pound plunged by more than 1% in just a few hours. For one of the 3 most traded currencies in the world, such a daily fall is extraordinary. It sent a blunt message. Investor trust in Britain is evaporating before our eyes. The debt has already surpassed the size of the entire economy. More than 100% of GDP. Nearly 8% of the budget, or 4% of GDP, is now spent purely on servicing debt. That's more than the country spends on education or defense. And this comes while the economy grew barely 1.1% in 2024. And worse lies ahead. Most of Britain's debt matures within the next 2 to 3 years. That means refinancing at today's punishing rates. The era of cheap money is gone. The new reality of expensive credit is eating the budget alive. The vicious circle begins. Higher interest costs mean fewer resources for everything else. The government must either raise taxes or cut spending. Both choke growth. Weak growth reduces revenues, forcing more borrowing. The higher the debt, the higher the yield investors demand. The loop tightens. And all this against a backdrop of global turbulence. In the US, 30-year treasuries are nearing 5% yields. America too faces massive repayments and refinancing of trillions. Against this backdrop, Britain looks like the first victim of a new debt reality. The question is, can London endure the pressure, or will the crisis of confidence spread across the Atlantic? When markets smelled blood, reactions came fast. Investors. Big funds began slashing their holdings of gilts. Once a symbol of reliability, they turned toxic. Capital rushed toward the US and Germany. Traders who just yesterday trusted Britain saw a red flag. If a country with such prestige can't manage its debt, who's safe? Currency. The pound suffered a true collapse in confidence. A 1% fall in a single day was a glaring sign of weakness. Even the Japanese yen, often called a pensioner's safe currency, suddenly looked stronger. Bank of England. The regulator tried to intervene. Statements about supporting stability, hints of softer monetary policy, even rumors of restarting bond purchases. But instead of calming markets, it sounded like panic. If the central bank is considering turning on the printing press, things must be dire. Government. Prime Minister Keir Starmer's cabinet was cornered. In the fall, they must present a budget convincing enough to restore trust. But promises look vague. Chancellor Rachel Reeves is drafting a plan, but investors remain skeptical. They still remember Liz Truss's disastrous mini-budget when confidence evaporated in hours. Global arena. Washington is watching nervously. If Britain buckles under debt pressure, the US could be next. 30-year treasuries are hovering near 5% and a massive refinancing wave is coming. In Asia, markets tremble. Hong Kong and Tokyo investors cut British exposure and move into gold and the dollar. Experts. Some warn Britain is repeating the 1976 crisis when the IMF had to bail it out. Others compare today to the Truss fiasco, but far worse: higher debt, less patience, more fragile trust. Ordinary people. For Britons, this isn't abstract. Higher bond yields mean higher mortgage and loan rates. A weaker pound makes imports costlier. Families already feel the pain. Food, fuel, utilities, everything is rising. And above all, the mood has shifted. Britain, once the world's safe harbor, now looks like the eye of the storm. To understand why Britain is in this trap, rewind the tape. The pound's path in 2025. It started in January when Trump's America First tariffs hit. For London, deeply tied to the US, this was a blow. Investors braced for trade wars. The pound weakened. By spring, it hit new lows, worsened by weak industrial data. A brief summer rebound fizzled in July when Starmer's budget plans looked vague. Then came the bond shock. Yields spiked and the pound collapsed in hours. An open economy's vulnerability. Britain is a small, open economy. Global tremors shake it far harder than bigger players. Rising US yields, inflation fears, tariff fights all hit sterling with extra force. Every pound drop fuels inflation. Imports get pricier, households suffer, confidence erodes. The budget trap. Debt now equals the whole economy, 100% of GDP. In 2024, nearly 8% of the budget went just to pay interest, more than on schools or defense. Out of every £10 spent, one went straight to bondholders. Meanwhile, growth in 2024 was only 1.1%. The country pays creditors more than it generates in new growth. The debt spiral. Most debt matures in 2 to 3 years. Cheap loans will be replaced with expensive ones. More interest costs mean fewer funds for growth. Weak growth means more deficits. Deficits mean more borrowing. Investors, sensing the spiral, demand even higher yields. The dangerous trio. Economists call it the dangerous trio. Rising inflation, a weakening currency, and lost investor trust. Britain faces all three at once, amplifying the crisis. Historical parallels. Comparisons abound. Liz Truss's mini-budget of 2022, when trust collapsed in hours. But today's picture is worse. Debt is higher, global tolerance lower, investor nerves sharper. Some analysts recall 1976, when Britain nearly defaulted and begged the IMF for help. The US mirror. For America, Britain's crisis is a reflection. Debt is massive, yields are rising, trillions need refinancing. The only difference is scale. If Britain cracks, London suffers. If America falters, the whole world does.